Hi, this is Ed with Remax. We have very interesting topic that we're gonna discuss how raising interest rate may change your mortgage payment and what steps you should take to protect yourself. Today, we honor to have Sergi, who's a mortgage broker with Dominion Lending and a real estate investor in Ontario. Hi, Sergi.
How are you all? Thanks so much for having me on.
Yeah, for sure. Thanks for, give us opportunity to be here.
My pleasure.
Yeah. Sergi, some economists predict the Bank of Canada may raise interest rate as much as 2% over the next year. How does that affect fixed rate mortgages?
Well, there's going to be two types of individuals, ones who already own a home. And if you have a home and you already carry a mortgage and it happens to be a fixed term, your rate and your payment won't change for the duration of the term. So you may have a 2, 3, 4, or 5-year fix, and your payment won't change for that entire period. But if you're somebody new who is looking to purchase a new property, or if you're looking to refinance an existing property, you're going to want to secure a mortgage rate hold with a bank, and that would be valid for 90 to 120 days. And what that does is it guarantees that when you do find a property, you're going to have a payment that's set in stone and it won't change for you when you actually go and purchase.
Thanks. And we have a variable rate mortgage. How do changing rates impact someone that has a variable rate mortgage?
Well, the Bank of Canada meets about 8 times a year. And at each of those discussions, they decide whether or not to change prime rate. And that's basically the overnight lending rate that's charged to banks. And then those banks pass on the savings or the cost to you, the person who's responsible for carrying the mortgage. And there's 3 components to a mortgage that are affected by prime rate. There's the interest rate, the amortization, and the payment. If you have a variable rate mortgage, then every time the Bank of Canada raises prime rate, and assuming the bank passes that on to you, your interest rate and your amortization will change. So for the next little while, your interest rate and your amortization will likely be going up when prime rate goes up, but your payment itself will remain the same. That's in a variable rate mortgage. If you have an adjustable rate mortgage, your rate and your payment will change every time the Bank of Canada raises prime rate. So that's what you can expect. And that's the difference between a variable rate mortgage and an adjustable rate mortgage. Sometimes people conflate the two.
Yeah, for sure. And how much will a mortgage payment change when the Bank of Canada raises the prime rate?
Well, as we discussed, of the 3 types of mortgages, 2 of them, the payment won't change. So on a fixed rate and on a variable rate, the payment will remain consistent. But if you have an adjustable rate mortgage, then every time the Bank of Canada changes prime rate by 0.25%, that equates to $11.87 per $100,000 of mortgage. So just to give you a real life example, if you had a mortgage value of $550,000, you would do 5.5 times $11.87, and that would be $65.28 that your mortgage payment would change. And that change would be every time the Bank of Canada changes prime rate by 0.25%. So that's how you could do some rough math to get an idea of how your payment might change over the next 12, 24 months.
It's great to know. And suppose someone is taking a new mortgage. What are the best way of someone to protect themselves in rising rate environment?
Right. Well, as we discussed, 2 of those products, the payment won't change. So let's talk specifically about variable rate mortgages. There, you're going to have a fixed payment, but your amortization is going up. You don't want that money to disappear into thin air. So if today you take a variable rate mortgage, and for example, the rate is 1.4%. And if you compare that to a 5-year fixed rate that's being offered, the rate might be closer to 2.94. That, depending on the size of your mortgage, might be a difference of several $100s. What you want to do is understand that the reason the spread is so big is because your variable rate mortgage will be going up. Interest rates will be rising. So to protect against that, you should look at what's the difference between the variable rate payment and the 5-year fixed rate payment. Assuming it's a few $100s, you want to set up a pre-authorized contribution from your checking account to a savings account or maybe a low risk investment account so that you're getting yourself used to making the higher payment that's associated with the 5-year fixed mortgage. And in the future, as interest rates rise, you're going to have the ability to draw on those savings to supplement your cash flow or to make a lump sum payment against your mortgage balance to bring your amortization back down. And what that does is it gives you extra free cash flow today while variable rates are low. It gives you a fixed payment that you have secured for the entire duration of the term. But in the meantime, that extra money that you're going to need in the future isn't disappearing into thin air. You're using it to build up a reserve fund that's going to help you supplement your cash flows or pay down your mortgage in the future. And by taking a variable rate mortgage instead of a fixed rate mortgage, you're mitigating the possibility of paying some really big penalties that are often associated with paying out a fixed rate mortgage early.
Yeah, that's awesome. I would like to take opportunity to say thanks for providing very valuable information for all audiences. And if somebody want to reach you out, please provide your contact information.
I appreciate it. Well, the best way you can get a hold of me and find all my contacts would be at DIY Finance Guy on Instagram. You could also reach me at sergiem at Dominion Lending. That's SERGEIM at dominionlending.ca. It's been great to be on with you. I really appreciate the opportunity.
Thank you so much, and looking forward to have more sessions with you.
Thanks so much, Elle. Take care.
Bye. Thanks.